Maybe get into the specifics, Ronnie, about for folks who don't know what the crypto futures markets look like comparative to the traditional futures. What are some nuances there? Where's the opportunity? Where are things to to look out for, as you mentioned?
Yeah, maybe to take one step back. So maybe just to actually clarify and say why we chose to do futures in the first place. So when we ventured in sort of to the digital space many years ago and started looking at it, and actually then we applied 3 years ago, the idea was, of course, that since we had investors on the traditional side and we were doing sort of momentum trend following in the traditional future space, we thought that, okay, if we want to do something on the digital side, then we'll do, sort of like a similar type of strategy, really to sort of bridge the gap between the two worlds and maybe make it really easy for our current investors to go and invest in that side. So that's why well, of course, there are other benefits as well with the crypto futures, but let's get back to that one. But that's sort of the main reason why we decided to do, perpetual futures instead of spot. Of course, going long, going short is much easier because you do not have to borrow anything and some financing costs, obviously, but still, in terms of the margins as well, naturally, when you trade futures, then you only of the margin. And another benefit, of course, which is quite fascinating for me coming from the traditional side, where it's the broker or the exchange rather that sets the margin, how much you need to post for holding a specific position. So basically, in the crypto futures markets, you can decide your margining yourself by sort of selecting the leverage you want to use when you go into a position, or when you purchase the contract. And obviously, you will be stopped out automatically then if the margin is wiped out. So there's no point in maybe using 100 times leverage every time you trade. But so there was some new features, of course, that we had to take into consideration. But yeah, so we went into sort of the future side, starting to look at the futures that were available in terms of liquidity, and then starting to trade. Of course, there's a lot of volatility in our trades every now and then. Of course, we've seen quite a few ranging markets as well that are quite difficult in terms, especially the volatile ones. But yeah, we then trade sort of a momentum chasing short-term trend following program, that where the average holding period is about 1 week. I would say maybe slightly longer in terms of good trends, but typically it's quite quick to react and adjust. And the main benefits, of course, with the futures market are these that well, first of all, compared to the traditional side, you want to buy a Brent crude futures contract, well, you have to buy at least the one, and it has contract size of 1,000, and it requires a little bit of money to be able even to buy one contract. Obviously, in the Nasdaq and S&P futures and many else, there are the mini and micro contracts, but they're still quite big. So it means that if you want to set up a managed account to trade any kind of, managed futures program, you still need to cost 1, 2, 3 million for it to make sense. We're not, to start
Size-wise, yeah.
Yeah, size-wise, not to get that tracking error, towards of the benchmark program, so to speak. And these are the things, of course, like that you don't really see on the crypto side, because you can trade, well, obviously 0.0001 Binance futures.
Yeah. Right.
If you want, and so on. So it's really convenient. Liquidity is obviously what the other thing maybe that surprised us a little bit, at